Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending September 2nd, 2022. I'm Preston Britton. Thanks for tuning in. Well, this week's theme is, has the Fed put gone poof? Meaning, are the Feds no longer going to come in and support the markets when they're going down hard because the Feds are too busy raising rates, taking money off the balance sheet via quantitative tightening? We'll see soon enough. So let's get into it and see what's happening these past few weeks. By the way, as we rounded out the month of August, it was not a very good month for market performance. This is a holiday weekend in the U.S. markets. Monday is our Labor Day, so U.S. markets will be closed. The futures market will open Sunday evening at 6 p.m. New York City time. And then close Monday at 1 p.m. New York City time. But outside of that, all equity markets, bond markets, all markets in U.S. will be closed. So let's take a look at where we ended up this past week as we rounded out the month of October. You can see here everything is in the red. Several weeks in a row of going down from moving up. You can see year to date, everybody's in either a correction territory or bear market. You can see on the right-hand side on U.S. valuations, you can see that the PE ratio, the forward PE ratio, is less than the prior 12-month, the trailing by over 18%. So that's how much earnings have been reduced in the markets. Forward PE is at 17.52. Dividend yield in the U.S. equities is 1.68% on Friday's close. Treasury at 3.19, which is about over 1.5% higher than the dividend yield. However, the earnings yield in the S&P is at a little over 5%. And you can see the yield over the 10-year Treasury, the earnings yield in the S&P over the 10-year Treasury is about 1.83%. But the real yield, when you throw inflation in there, is still negative. So the Feds still have their work cut out for them. They got to get those rates up. And the current VIX, you can see it was pretty much flat for the week. The prior week it finished at 25.56. This week's at 25.47. So you could probably say it came down, maybe about 10 ticks or so, 9 ticks, but it's still relatively flat for the week. I think investors this past week are trying to digest the implications of all these messages from Boom Boom Powell. That would be our illustrious Fed chair. As I said, the month of August, we saw the S&P fall in more than 4.2%, and that's after a 9.1% hike in July. So we've given up almost 50% of the move that we made in the month of July with that big run up. Q2 earnings, we see stocks fell a little bit short of those earnings. Those stocks that fell short of their estimates or they issued disappointing earnings guidance were punished dramatically, more so than those that beat earnings estimates were rewarded. So the markets are in no mood unless you beat both top and bottom line to give you any valuation credit in these markets. And I'll note that the current Fed funds right now are projecting a 75 basis point rate hike for the coming Fed meeting here in September. Currently, though, funds, they're about 90 of, if you take all historical readings of big mutual funds and where they are and their relative exposure to equity markets, it's at 90% on the bottom end side, 90 percentile. So they still have a lot of cash on the sidelines. They're just not really allocated to equity. And because we're rounding out the month of August, kind of starting off in the fall season, September for U.S. markets has traditionally not been a good one. And one interesting stat I'll give you guys, the S&P 200 simple moving average has been declining for about 90 days now, okay? A little over 90 consecutive days. And that's happened 23 times going back to 1990 or going back 92 years, 23 times. Now, on the 90th day of having declined 90 consecutive days on those 23 times, the S&P dropped a further 5.8% in the following 6 months. That would put our current S&P down around the 3,700 price level. So that's not really that far off from where we finished on Friday at 39.33, right? So you're looking at maybe 233 points lower in the markets. So that's not really that bad, I don't think. But It does show the tenuous nature of the markets. Now, this past Friday, we did get the jobs report out, and the markets, it was kind of a Goldilocks jobs numbers, not too high, not too low, kind of helped propel price action higher until midday. Reuters was reporting that Russia is going to do a complete shutdown of the remaining 20% of gas flowing through their Nord Stream 1 gas pipeline. That quickly shocked the markets. The S&P did a 100-point reversal to close near the lows on Friday. The Dow did almost 850, 860-point reversal to close into the lows going into the holiday weekend. So that just showed, and I suspect on Monday when markets open in Europe, there's going to be some major issues going on over there. Okay. So that Goldilocks scenario where those job numbers did not last, not even a half a day. Now, the evidence of continued tightness in the labor markets, I think, helped push U.S. Treasury yields higher. Okay, the 2-year Treasury yield actually reached levels not seen since 2007, right before the great financial crisis in '08 and '09. Keep in mind, though, really the only real way to reduce inflation, they got to get that unemployment rate higher. Bond traders, as I said earlier, have come to expect the Fed would rush in to cut rates and loosen monetary policy anytime the economy showed a hint of weakening, which is, as I said earlier, often referred to as a Fed put. But I don't think they're going to be doing that this time. Fed Chair Boom Boom Powell seemed to be putting that assumption to rest during his very short Jackson Hole, Wyoming 8-minute speech roughly last Thursday. Not this, about a Thursday ago, a little over a week and a half ago. Okay. Now, over the long term, keep in mind the price of the stock's ultimately going to reflect company's performance and its ability to grow earnings. But it will be impacted by the Fed near term. And that's kind of where we're sitting right now. Okay. So you can see all of this data here. There was no sector this past week that finished in the green. The best was utilities, which tends to be a risk off sector, but it was down 1.47%. The worst, technology, which was down a little over 5%. Communication services year to date, 30.35%. Energy, see, it's been leading the way since the beginning of the year. It's up 47.808%. Okay. Now, if we swing over and look at the rest of the global markets, or the main ones anyway, if you look at Europe first, we'll start there. Their shares obviously are down and started going down hard when the central bank there, the odds and their analysts are projecting over 75% chance of a rate hike, 75 basis point rate hike, 80% chance of a 75 basis point rate hike in the ECB at their next meeting. Inflation in Europe has accelerated a lot more than expected. It went up to a record 9.1% in August. That was up from 8.9 in July. And of course, surging energy, food prices, those were the primary drivers. Okay. Now, the other thing that really is going to set the market on a tizzy early next week, depending on what happens tonight going into tomorrow, is Russia is stopping their natural gas pipeline supplies in Nord Stream 1, as I said. We'll see how that thing shakes itself out, but I don't give it a lot of hope right at this point in time. Okay. And notice they did that right after the EU signed a deal with the US to do price caps on Russian oil. So it's just going to be tit for tat. It's going to be a real interesting play. And if we go over to the UK, the pound had its worst steeply monthly drop versus euro since their breakaway from Europe, right? In the EU, the pound fell more than 4% in August, sitting around 116 to the dollar right now. And it also declined 3% relative to euros. So they're just getting hurt from all different directions. Okay. And of course, if you look at it, everybody was in the red in Europe, with the exception of Germany. It was kind of a rare holdout, but they're all down year to date. As you can see, FTSE's holding up the best, right? And then, of course, if we go over to the Asian markets, you can see Japan, the yen breached 140 against the US dollar for the first time since 1998, over 24 years ago, because our central bank is diverging from their central bank. Bank of Japan is still pumping money and stimulus into their economy. They want to get inflation up a lot higher. And the U.S. is doing just the opposite. We're starting quantitative tightening, reducing our balance sheet, and raising rates. So you would expect to see that divergence in currencies. And of course, if we go to China and Hong Kong, well, in China, um, they said they would implement a landmark audit agreement that was struck with the U.S. Both countries, U.S. and the U.S. listed Chinese companies, rather, it's kind of been a year-long dispute, and it threatened to kick off about 200 Chinese companies from U.S. exchanges. But I think China needs those companies now for investment purposes and everything else. So they're not going to do. They're going to do everything they can to keep them on there. So that helped out sentiment a little bit. But I will point out, as I've been telling our members for the past 90 days or so, China's economy is in a notable slump. Data in everything from factory activity, their consumer spending, housing, especially housing and real estate, are all in a decline. And now on top of that, they got their worst heat wave in 60 plus years. They got drought, and then they got ongoing COVID-19 restrictions, right? All of these things are just pushing China down and down, and they're going to create huge drag on China's economic growth. So the heat wave and the droughts led to electricity shortages. It's going to further curtail manufacturing activity. Their PMI came in below 50, which shows contraction. Property developers are also reporting a plunge in activity with sales off more than 30% compared to year over year numbers. So all in all, the global economy is set, I think, for further downside. Now, we're going to have some bounces in the market. I do believe over the next couple of weeks we could have a bounce. I think October is going to be a little bit uglier, and then it's going to set up for an even bigger bounce later on, right? So these are some of the things that I see in the markets. What I'm going to do is I'm going to shift the screen over now and show you some of the U.S. markets here. We're going to take a look at the E-mini S&P 500 futures. So let me just shift this over here, get it on the screen for you guys. Let's see, here we go, right here. It'll take a couple of seconds, 15 seconds or so, to come up on the screen for you. But what it's going to show you is just how much damage has been done over the past few weeks in the markets, okay? Like I said, in July, the markets were up about 9.1% from July. And then in August, we were down, 4.2% or so. You can see here, this is an EMA, exponential moving average, 200 EMA. It's been moving down. It rolled over a little bit back on August 26th. And here is the 50 EMA. It's also pointing down. So when you got all exponential moving averages pointing down and price action below the 50, which is below the 200, folks, as I've been saying, since it crossed, this is a bear market chart. We got to view with suspicion every move higher, even this big move that was made off the lows that were made back on June 17th of this year. It's a false sense of security. We're not seeing any follow through in this market action right now. And we pull back. Now, notice this is an Elliott Wave 3 count, which suggests we're going to find some support here and have a little bit of a run up. First overhead resistance is going to be the 50 EMA sitting right around 4,065, 66 area. Notice it's right now the markets are tracking right in between a resistance zone and a support zone down below. Okay. But if we clear the 50, then we got to clear the 200. A lot of damage has been done in these equity markets. And of course, if we look at the Dow, take a look at what the Dow's been doing. It's coming down very hard as well. Notice the Dow Elliott Wave count is slightly different, but it does suggest that any move higher is possibly going to roll back over. And we got to assume that for all equities right now, all equity indexes, U.S. indexes. All right. And then, of course, if we look at the, let me find it on here. I know, here we go. If we look at NASDAQ, you can see here, same thing. We're in an Elliott Wave 3 down. It's projecting NASDAQ could come down and actually take out our lows of a little over 11,000 that were made back on June 16th, right? And that'd be another 1,100 points down. I could see that. I think we'll get a little bit of a bounce, give a little bit of false sense of security. The bulls will come out, and then it's going to roll right back over again. So again, be very careful on that. And of course, if we look at the Russell small cap index, you can see the same thing. Although the Russell and the S&P are, from an Elliott Wave count, are a little bit more aligned, better aligned. And the Russell was down on June 16th, almost 34%, 33.33%, really. So, but we've taken out all these, every single one of them. The 200 moving average and the 50 moving average are all pointing down. Price actions below the 50, which is also below the 200. Those are bear market charts, guys. So we just got to watch it very closely. Any rally, as I've been telling our members, I recently said we've been in a buy the dip during that 4-week rally, 4.5-week rally we had off the lows. It was a buy the dip moment. But then once we started coming down, it was still a buy the dip moment until we took out the 200 EMA. And then it was like, okay, let's wait for a retest. Sure enough, we got a retest, and most charts are very similar to this. We retested the 200. It failed, and then that buy the dip kind of came off the table because we're still in a buy the dip, but we're not ready to buy yet, right? Markets are still coming down. And of course, if we come over here, let me just look at volatility. You can see the VIX. It barely moved for the week. You can see we're just in this choppy range right here. And that's a good sign, believe it or not. The VIX and the term structure of the VIX, which is either contango, which is normalized, or backwardation, which means there's more near-term fear, they haven't really moved that much. Let me show you the front month volatility skew. You can see here on this thing, it actually closed Friday in the green, almost right on this line, okay? Now, the volatility futures for September still has a few weeks to go before it expires, but we're in the green. So the markets, even with this downdraft, it's almost like the VIX does not want to climb much more than 30. And if it gets up to 30 or 35, buyers tend to step in, okay? Now, if we look at the back month skew, it's even more in the green, right? We're much more solid in the green. And until we get near the red or in the red, the markets just don't have a lot of fear right now. Now, I don't know if that's misplaced, but we've got to follow what the numbers are telling us right now. And it says there is caution in the air, but we're still in a buy the dip mode right now. So we're not ready to buy. For members, when markets open on Tuesday, because here in the U.S. markets will be closed on Monday, you will be able to watch the futures, how they open this evening, Sunday evening, and where they close on Monday. But I suspect it'll be in reaction to what goes on in Europe and China, because they'll be driving the markets until the U.S. comes back in again. Okay. If we come down here and look at treasuries and we look at the bond market, it was up a full handle. Okay. Look at how bonds have come back over again, okay? Now, when bonds go down, interest rates go higher. And this movement lower is basically on the idea that the Feds are going to hike the rates more than people thought, okay? I mean, they basically came out and said there's a little bit of a mismatch between what we want to do and what the markets think we're going to do. Because Boom Boom Powell so far has always been a dove when it comes to hiking rates, but he displaced that notion last Thursday, not this past Thursday, but a week and a half ago. He basically said, we're going to do whatever it takes. And that moved the markets lower. We could probably see interest rates go up a little bit higher. And if we look at the interest rates, we'll look at the 10-year US. If we look at the 10-year US, you'll see here that my last target for the 10-year US was 3.3, and we actually took it out and went up to 3.48. I do believe we're going to kind of get back up into that area again. It's going to be a grind and a chop, but that's kind of where I see us near term. Okay. If we look at currencies, if we look at the US dollar, it's holding up fairly strong because it's a dollar index. You can see we actually made new highs. We hit my target. My target was right at 110.105. We hit 109.98. We're right in my target zone here. We got a little bit of a divergence set up, so it's going to have a difficult time to hold this unless I think Europe is going to be in for a deep recession and a longer lasting recession. And depending on how the Feds react to that here in the US, it could strengthen the dollar or weaken the dollar against the euro. I'm not ready to go long the euro yet, but I think it's going to be a good trade when it starts to move. And if we look at the euro right here, you're going to see the euro is down around my target, and it sits here. And every time the euro hits that 50 EMA, it pulls back every time. And you can see here with the euro, look at these settings here, and I just roll these down every time, creating a new support area. I think this is going to be about the bottom of it, and we're going to chop around here for a while. And then you can see how the euro has reacted against the 50 EMA. It can't climb above it, right? Check over here. Can't climb above it. So we've challenged it 4 separate times. Every time it's failed. I think the next time it challenges it's kind of probably stay there. And once it clears the 50 EMA and gets some juice behind it, it's going to run for a while. And that's going to be a great trade. But it's not there yet, guys. We're just not ready for it yet. And of course, if we come down and look at gold, as you guys know, I've not been a gold bull. I've been more of a neutral to sidelines guy. Gold kind of moved up a little bit on Friday. But I think we're going to take out the 2022 low in gold. I think we'll probably come back down here, down around 1600. We're going to settle in down here, and then I think it's going to start to run higher, right? That's a little bit about gold. Silver's the same thing, although they both were up on Friday. You can see my target for silver has also moved down to about 16.63. Okay. We actually made new lows in silver. Let me just see if I can get that on there. Right there. So the new low there was about 17.62, and that was following a low the prior day of about, actually that was actually lower the prior day, right here, right like that. There we go. Let's just get this thing all set up here. So, but we're seeing a lot of weakness in these precious metals, but we need to use this for a longer term buy, not just yet, but when we get the signal, it's going to be, let's jump on it. Okay. Now, if we look at copper, which kind of is, it's called Dr. Copper because it follows a global market strength or lack thereof, you can see it's just come down very strong here. My target for copper is down around 2.94. That means we can move a little bit lower. Once we get down here, it's going to be a good opportunity to go long copper. And then if we look at energy, energy is coming down a pretty good little bit, right? It cannot climb over that 50 EMA. We have a way, our members have a way of trading. We trade oil futures a different way than just being a directional trade. And it's worked out very well for us. And it's a lower risk way to do it than some people think with naked puts or naked calls, which you can get in a lot of trouble with, or credit spreads for that matter. So this is kind of where we're sitting with oil. I think oil will probably find a spot down around the 84, 85 area, which is kind of where I've always been with it. And then it's going to chop around in a 5-point range, $5 or $7 a barrel range for a bit. If it climbs back over the 50 EMA, we'll probably move back up into the low 100s again. Again, I would not be surprised. The other thing that's driving oil down right now is the thought of a global recession. If Europe goes into recession, China's coming in not at a recession, but just very low, slow growth. And the U.S. is either a soft recession or just very, very tenuous as far as how the economy is looking. Oil is going to go lower. It's just a natural. So that's kind of what I'm seeing there on all these. All right, everybody, that's kind of where we're sitting here. Members, we're taking this evening off in our weekly market watch. I'll see all our members on Wednesday morning at 7:30 a.m. New York City time for our pre-market trader. Otherwise, everybody enjoy the holiday weekend. For those you international members, have a great evening, and we'll see everybody again this Wednesday at our pre-market or next weekend in our weekly roundup. Take care, folks. Ciao now.